Hi everyone, this is the 18th of September 2019. The markets closed completely flat but at the low end of the range. Now yesterday it did something very interesting, which is it broke, if you simply draw a trend line of the last two lows, and it closed below that. Yes, the video you're watching was recorded yesterday, but I'm aware today we sold off again from that point. So we paused and then we sold off. But note, this is the same trading range now for almost 1.5 months. From the start of August, we've been in this range, up, down, made a new low, up, down. We've really not gone outside of it. But between here and here, it almost feels like the world has come to an end. So that sentimental angle was really important. And the second is, this is the breakdown point that I'm talking of. And this is where we are right now. And let's go on from there. And that gave off a signal that I think many people who were still bearish on the market were looking for the next sell-off that should happen all the way down to 10,300. Now the reason, and I've been posting I think a lot of my analysis which has been published recently in various media, that there's reason to believe, and I think that was also part of my monthly report, that sentiment is really at an extreme, and this is not new. I think I've been saying it now for several weeks, because I think this is the first time in a long time that we spent an entire month in the same trading range. So actually speaking, while it may look like we've had a lot of up and down, the Nifty really just moved between 10,640, that low that we made, but broadly between 10,800 and I think 10,150 on the upside. It just zigzagged between this all the way from the last week of August into the current week. So we've seen several moves, and you can make calls in terms of which side it's really heading. And every time it heads to the lower end, you actually would think that it's going to break, but at the same time there are many stocks that have held on to their lows. So we really need a clear breakdown. And the one alternate that people are countering me with is that there's still a fifth wave left. So I just thought up and everybody's thinking that will go to 10,300 or something. But if you simply think Elliott wave wise, if the third wave was extended, and if the fifth wave is really just going to be the size of the first, then you really don't go much below 10,650, which means near a double low. And if you even go a little below that, let's put 10,600 as the base case. In a worst case scenario, if at all that happens, and I'm saying if at all that happens, because the sentiment extremes are still as crazy as they were. The FI positioning, which was earlier at its peak in the futures market, and the peak data was actually on the 28th of August. So while one of my published articles is being picked up and thrown up on Twitter for the 13th, because that's when we actually published it in the Economic Times, but that was not the highest short position. We got the peak position on the 28th eventually, and so that would stretch us out till the end of this month, 20th of September. That said, the options positioning yesterday on the put side for FIs also went into an extreme. So they essentially been negative and short in the market. They've been selling in the cash market as well, and I think that's what is dampening sentiment in general. But other than that, we did get somewhat oversold. So we really need to see how you're going to get that next breakdown. And the question is, if you're simply looking at that as the fifth wave, and if that's the breakdown, if it's really 200 points, and what is the upside, then it looks like the upside downside risk is not really extremely favorable anymore to be negative. That's the reason why I think, irrespective whether that happens or not, you're still going to possibly hear me sounding out more positive than negative, unless some serious damage happens. And the risk of that was essentially over this weekend when you had the oil price spike. Now I'm again jumping in. I've done several videos on the overlay of Nifty and crude recently, so you can go back and check those, essentially to show you how both tend to be positively correlated. In general, equities and commodities have been so, because they usually move up together in a reflation trade. So of course, there are times when you've seen commodity prices fall as well, but the rising trend has never generally been bearish for the segment. So without going into detail on that, we simply take up the current period. We've seen it since 2016. Oil was up, Nifty was up. This is oil on top. Again, you had a partial correction here. Nifty continued, oil continued higher. So the last time we got to $75, it didn't really matter to equities. They continued higher all the way to this point, and eventually first equities corrected, then oil corrected, and then again here you have both of them advancing. Now you have Nifty itself going through a pretty severe correction during this phase, and I started to expect oil will move up because it was not breaking the $50 mark, which I thought earlier it would, and so that changed my view. Unfortunately, the view change and breakout has come on the back of a geopolitical stance than the actual reflation trade. So but I'll still look for more upside, because I think despite this move, and this is now discounted, oil's trend should have changed and should remain positive. What we aren't yet getting is the Nifty really turning around, and that's the question we are dealing with. And more because of the geopolitical risk that was building up. I have not been negative based on oil. I think I wrote a piece on that yesterday and sent it out almost everywhere, that oil prices standalone, and this is the fifth time that we actually reached the $60 mark. The previous 4 times that we got to the $60 mark, the Nifty the first time was at around 2000, then it was 3500, 3600 something, and then the last time more than a year back it was at 10,000 in 2017. So each of these times, the rise in oil prices, even when it crossed $60, did not really cause much of an issue, and you simply had the markets also move up together, because most of the time it was a reflation trade. And once again, you have oil prices rising. Only this time there was a geopolitical angle, and I think that, of course, you can say could be some risk, but no other market apart from India really reacted so much to it. In fact, even where you actually have major tensions going on, like Hong Kong, that market itself has recovered in the last 1 week, along with the rest of the Asian markets, and the volatility is actually reduced, somewhat discounting the recent events, even though the events continue, these strikes continue there. But India, apart from all the weak economic data that has come out, I think that's where the sentiment is really gotten dampened, is after the elections. A lot of hope was lying on the budget causing a turnaround to the economy, and the market got a little depressed about that, and we did get the sell-off. But now you're slowly getting measures on the other side. Will it work or not is a very separate question, but I think the bigger deal is going to be the central bank intervention that has started with the Eurozone already going back to QE, and the Fed speaks tonight. So I think that's what we really need to be watching out for. What is the dollar going to be doing? So yes, the Fed did cut interest rates by 25 basis points overnight. But we have to look at what the dollar is really doing, and this is important because I discuss it in all my podcasts. And my long-term view had been that we had actually topped out in the dollar index in 2017, and that's when I became bullish in the commodities and metal space. And then you had this big drawdown. Now from there, you've been seeing the dollar index rise. It went beyond the 61% mark recently, possibly a little above even the 66% retracement mark. But what's really important here is that it lost its speed after the move that it did into December of 2018, when markets were extremely weak. But after that, the dollar index continued to rise. And as it's done that, so initial move was on the back of most of the developed market currencies, the euro, pound, yen. Those are the typical drivers, either on stimulus or on Brexit. Each of them have been weakening their currencies, and when they stop doing it is when you start seeing weakness in other emerging market currencies, which is what we saw during this phase. And that hit the Indian currency as well, as it went beyond the 69 mark that it had not broken earlier. So while all that currency war and crisis was happening, the DXY was simply moving within this range, trying to break out. But every time it got to the top end of the range, it became extremely overbought and then sold off again. And this has happened for the third time, after which I've been thinking once again that the dollar may be topping out. So the event last night was important because most central banks have gone back to quantitative easing or to cutting interest rates, all of which is stimulative. But the question is, who's going to be winning the game this time? And is the US going to move much more than the others, which is when the dollar would fall? So the dollar did peak in terms of price terms and has made one lower top. Yesterday after the event, it barely went up, though most of the news channels are reporting it as having risen. But as you see on this chart, it's a very small tick. What we are now looking for is follow-up action. And does the DXY continue lower? Because once it does that, then it would further confirm that we are getting a trend reversal and that the dollar index is actually heading lower, which would then become somewhat bullish for the reflation trade, and emerging market countries whose currencies were under pressure then get some kind of relief. And so I think that's what we are looking for. Even though you're already seeing relief in most EMs, I think India is the only country where you haven't seen a bounce back on the equity side, even though the USD INR appears to have stabilized. So that's the last thing that we haven't got, or we are still watching out for. So the DXY remains important. I think next few days we see whether this trend resumes, and it should tell us something. The most interesting part about this time frame was that gold prices actually went up with this flattening in the DXY, even though in general the dollar was heading higher. And so what does gold really do when the dollar starts falling? That we'll see. The dollar has spent almost 8 to 9 months in a narrow range, whipsawing both ways, initially looking like it would top, then it continued to stretch. It looked like it would break out on the upside. And even though various dollar pairs have actually outperformed the DXY in terms of currencies weakening against the dollar, the DXY itself has not gone beyond the 66% retracement mark and then finally gave up a couple of weeks ago. And now ahead of the Fed, it's actually, at least on the daily charts, looking like it's weakening. And you'd want a further confirmation on weekly charts. So maybe the event itself gives us that confirmation. So the next 2 days I think will be important in the dollar giving us those clues. And if the dollar starts weakening, then you have some hope of at least relief from the dollar market, because that's where the pressure has been. Whether you take the overnight repo issue that came up last night, which shows the shortage of money, and the Fed had to actually dump 50 to 75 billion dollars based on reports into the money market to keep the overnight money market rates from really going out of sync. But of course, some of that has to do with quarterly closings and various other near-term issues. But that said, a pressure point did build up because quantitative tightening is also ending this month with the Fed, and I think that risk needs to get mitigated by what the Fed actually says tonight on either the trend for interest rates and whether it will actually go back to QE itself, if not now, maybe later in the year. And those announcements could play a big role in where the dollar heads, and whether then that kicks off another reflation trade and brings back interest into equities. So I think that's going to be the real kicker. Most markets already anticipating that, which is why they already higher. And I think it's our own market that is not being able to anticipate this move, simply because our domestic data points got extremely bad, and that sentiment is continuing to play on us, and we are not really responding to what is happening in other parts of the world in terms of anticipating that move. But I think after that event, if it does move in the direction that everyone is really thinking, the all eyes will then shift towards the Reserve Bank of India, which in October is also likely to move along the same path. There are already forecasts of them cutting rates at least 50 to 75 basis points over the next year. And whether they do that much or whatever they do, they're at least in the direction of lowering rates. And right now, with inflation at its lows, most of the economic data at its lows, there's actually room for them to do that, which would weaken the currency. And in my mind, while that can weaken your currency, this may be one again odd occasion where the currency market and equity markets somewhere correlate for a while, because it would be a form of stimulant to the markets themselves when you attempt to lower rates. Whether it causes bond yields to fall or not, that's a completely different thing, because bond yields have moved ahead both in the US and in India in terms of where rates actually are. And so they need not really reflect the immediate moves, but it's the financial markets that would actually pick that up as a trend that a lot of liquidity is being continuously injected to keep things from going into a risk zone. The question is, will it eventually work in terms of getting growth back? A lot of people still doubting it, and we really will figure that out later. The first impact is going to be, what is this liquidity going to do, and in which financial markets is it going to go, and that's where the trade and speculative bets are going to fly. So that's all in my update for today. Thank you.